so excited today to have our panelists here. First of all, we have Mr. Scott Hine, and he is with Union Home Mortgage. And what award did you just win?
Mortgage Professional of the Year at the Home Builders Association of Virginia.
Woo! Yes, yes. Okay. And Carrie Fincham, and she actually brought some little things for you guys that you can take home with you. And she is with Fairway Independent Mortgage. And Carrie, what are you known as?
My little lender.
Yes.
Stand up.
And then we have, of course, none other than the infamous Mike Lee from Summit Mortgage. Woo!
And I didn't win any awards. So.
No. You won last year for the that I won this year, the affiliate of the year. Okay, all right. He's also my boss, so I have to be really, really nice to him. Okay, so we have got some really great questions, and we will have time, yes, to go over some of these afterwards. And in the interest of time, I may not be able to get to all of you for the same question, but we will definitely be hearing from all the panelists. So, when I hear a point, my clients, they need to pay down a point. That's like $1,000, right? Okay. Scott, you want to start with that one? What exactly is a point?
The simplest definition is just prepaid interest. So you pay a portion up front, you reduce your interest rate over the life of the loan. Now it's more than that. That's overly simple, but it's there's adjustment. Every loan program has a base rate with the lender, and then there are adjustments on top of that. We call it the price. Some people get focused on the rate, well, you can't separate the rate and the price. So the points are just basically how you get to the premiums that need to be made, or the profit margins and those kind of things. So prepaid interest points are neither good nor bad. They're indifferent. Sometimes they make sense. Sometimes they don't. It depends on the circumstance in the market. Like right now in a high interest rate environment, not seeing many people voluntarily buy points, because sometimes they have to pay points just to get to an acceptable rate. But why pay points when you think there's a likelihood of refinancing in the near future? On the other hand, when rates are low, if you don't think you're going to refinance it again, pay the points, buy it lower. But the math side of it, 1 point equals 1% of the loan amount.
Oh, 1%, not 1,000. Okay.
But with the number of $100,000 homes we're getting out here, it's probably
Right, because we have a lot of $100,000 homes around here. Yes, is that what y'all are finding? No.
Well, easiest way to explain to clients is like points like Costco's. You pay membership, right? And you get discounted for what? Yearly, right? That's what it is. You pay up front to get discount.
Okay.
Simple as
Okay. It's like a Costco membership.
Yeah.
All right. I like that. Cool. Carrie, you got anything to add?
So I explain it a little bit differently. I'm a math nerd, and my clients typically are not, and my realtor friends are not math nerds, or you wouldn't be selling houses. So it's my job to be the math nerd and to say, okay, at what point does it make sense to pay points? Because there is a break-even period. And so it's my job to do the math and say, okay, you're going to save $200 a month if you pay 1.5 points on this loan. You're going to make that money up in a 3-year period of time. If you're planning on staying in your home for at least 3 years and planning on keeping the mortgage for at least 3 years, then it makes sense. So I just kind of walk through the client. Each client is an individual and their circumstances will vary. So whether or not it makes sense to pay points, it's for us to discuss with our clients and explain the math to them, why it may or may not make sense. Because you have people who are adamant, I'm not paying any points. Well, okay, you want to pay $500 more per month? Don't pay any points. Here you go. You give them the options. Like Scott said, there's prices associated with each and every rate. Everybody wants the lowest rate. Well, there's a rate sheet. There's a low rate on the chart that's going to cost the most. There's a high rate on the chart that maybe we can give you money towards your closing costs, but you're paying for that. over time. And there's some point in the middle where it doesn't cost any points, but we don't give anything. But it's always the client's decision as far as how many points to pay and what makes sense.
All right, cool, awesome. And so the great thing about working with your fabulous lender partners is that, again, they do all this. You don't have to, this is for you to know and for you to be able to advise your clients about what lender to go to, but you don't have to do the math.
That's 3 great
Yeah.
descriptions for depending on what
Yeah.
type of client you have. If they just want the easy peasy or the more in depth, those are great.
Yep.
Yeah, it depends on the client, but right now, like Scott said, with the rates, high as it is, and it's gonna come down. So likelihood of them refinancing within 12 to 24 months is very good. So, it depends on,
Well, the people who didn't refinance when rates were so low before.
Well, here's the thing is that, the numbers don't lie. I mean, if you look at the chart from '80s, when the inflation's hot, we always have recession, and recession is a lower rate. And since '80s, it's mathematically, numbers don't lie. When you have a recession that, when you have inflation that high, back in '80s, we had a double dip recession twice, and the inflation went up in '90s because all the costs were going up due to dot-com companies. Remember dot-com when it skyrocketed? So the
I
inflation
think
went
some
up.
of these agents might not even have been born in the 90s, but okay.
From
It's all
historical
cyclical.
point of view, the recession always follows. The reason why we had 3% and 2.5% interest rate for the last 2 years is due to recession caused by COVID. We're not going to have another major thing like that. Maybe not.
Let's say.
And if that happens again, then rates will drop. So the rates right now, we're at the highest, inflation we've seen in a long time, and it's going to follow by recession. The numbers are coming down. So I know some people, my agents like, well, we're going to have housing bubbles. Like, no, not in this area because we're recession proof in this area. Even the government people get laid off, they still get paid.
Yeah.
When the
Yeah.
government shut down, they get paid. And there's always people flying in especially with the war going on. You know how many Pentagon people military transferring to this area? It's just incredible amount.
Mhm.
So the rates will fall, not to 3%, but we'll get to that point later. But the numbers don't lie. Recession always happens after inflation.
All right, cool. Okay, so everyone is talking about assumptions, okay? That's like the big buzzword around. But what does that really look like? Carrie, you want to take that first?
Sure. So assumptions are not a mortgage lender product; they're a servicer product. So if you have a home and you have a mortgage and it's a government mortgage, USDA, FHA, VA, it's assumable. What does that mean? That means that your buyer can come in and take over that loan at the same terms. So if they have a great, 2.25% VA rate, that's fine. They'll have to get secondary financing for the rest of the money because you're not selling your house for exactly the payoff on your mortgage. But you have to go to your servicer as the seller and ask them for an assumption package, and each process will be different depending upon the company, and there will be an associated cost with that. There's usually some sort of assumption fee, but it's a lot less expensive than just getting a traditional original mortgage. But you will have to work with a servicer versus, I don't know if Union Home, you guys service a lot of your own mortgages, so I don't know if you personally handle assumptions
It's
or not.
back office,
Right,
ivory tower type stuff.
So it's all dependent upon the servicer, and you will have to coordinate and stay on top of your seller and help them figure that out. And if you have a great lender partner, they might help you even if they're not sure.
True. Mike, you got something to add to that?
Assumption, right now, assumption is kind of like a fairy tale right now.
It sounds like.
Because in the last 2 years, we had what, 30% increase in home value, right? So if people bought it for $250, not selling for $350. Now that assuming that loan, that number cannot change. So your client has to get $100,000 second loan at probably 10-11% interest rate. Okay,
Mm.
if you calculate the payment on 100,000 with a 3.5%, the payment's going to be pretty much the same. And why deal with that headache? And that's kind of fairy tale. The second trust, and then trying to go through the servicer to get assumption. There's some nightmare stories that people can tell you about that. I mean, seriously, it's not that easy as people think. Now, when somebody bought it at 4%, and 2 years later with the moderate, 3% increase in home price sales, yeah, that might work, but not in this market, because people have too much equity. National report came out. Most average American have 40% equity in their house now.
Oh.
And there was going to be, people think there's going to be a foreclosure, about stuff happening. Nobody's going to foreclose with 40% equity. I mean, they'll
Yeah.
sell it.
Mhm.
So, housing market is still strong, and rates are high. Well, who cares? I mean, they can refinance down the road. It's not, it's not a bad thing. So people just freak out, and most people are not used to it. I tell people like, hey, the rate's at 7.25. He's like, I don't care. I'll refinance anyways later. Confidence, educating your clients. But the assumption, nah.
We wish.
Scott, you got anything to add to that? That's
I stopped thinking about them. There's a handful of them out there. That cash buyers are up to about 20-25%. So there are people who have the cash to pay that difference, and are, typically if they do, they've got other investments. So if they can have some of the mortgage at 2.25, 2.5, they'll do it. But you're not going to build a business model out of it. So I would deal with it if you come across it. And,
yes.
not-
Hand it off to your lender. That's what you do. Okay. Now, some things that they've all been talking about is lender and servicer. Does everyone understand the difference between lender and servicer? No? Okay. All right. So,
Do you want me to answer that 'cause
Sure.
I brought it up?
go. Yes. It's all your fault. You talk
It's
about
all
it.
my fault. I will take 100% responsibility for that. So your lender is your mortgage company that gives you the money. Your servicer is the person that collects the payments. So anyone here who has a mortgage has probably had their mortgage sold from one place to another. That's the servicing rights that are being sold. And that's the people that you call when you have a problem and they, fix my escrow or whatever your problem is. So the servicer, they take your phone calls, they collect your payments, but they were not the ones that originally gave you the money.
Okay. And how many of your own loans typically do you service yourself?
all of them.
All of them? What about you?
A very small percentage.
Mhm.
We serve all conventional loans.
Okay. See, so again, I mean, it's whatever your lender's policy is or whatever. But I mean, typically, a lot of the times they are serviced by someone else. So don't be scared. Okay. All right. So, does filling out a loan application affect your credit score, Mike?
The credit pull is usually 5 points
Okay.
or 2 points.
Okay.
Whatever it is. It's not that much.
Okay.
And you can shop around just like car. The government passed a law where if you're shopping for a car loan or mortgage loan, you can pull many times you want in 30 days. It'll only count as one hit.
Oh, okay. So
when people people always tell me it's like, I don't want my credit pulled. Well, I can't really get you pre-approved without pulling your credit. And then some lenders offer soft pull, and soft pull is fine, but it doesn't give you the whole story. So it's 2 points, and what you qualify for is worth getting your credit pull and get fully pre-approved. So it does hurt your score 2 points, but if you're at 600 and you want to go to 598, then there's a problem. But other than that, and then Credit Karma, people say, well, my Credit Karma says, I'm like, no, Credit Karma is just like Equifax, TransUnion, and Experian and Credit Karma. Nobody uses Credit Karma score to average, so it doesn't really matter what Credit Karma says. So
okay. Y'all got anything to add?
Yeah, I would. Lenders of all stripes, not just mortgage lenders, use that as a scare tactic. Yeah, I talked with a client last night. he was dealing with a broker, real small shop, didn't really offer the program he needed. And they, don't get your credit. I had upper 7 credit score. An inquiry wasn't gonna hurt him. There's a lot of, so there's 3 repositories. Everybody knows Equifax, TransUnion, and Experian. That's where the data comes from. But I've heard as many as 70 different algorithms. So like Credit Karma and a lot of banks, they use what's called a Vantage score. Most mortgage lenders using a mortgage tri-merge. It's pulling from the same data, but it's weighting it differently. It's going different time frames backwards and forwards. And so, people say, well, I got Credit Karma, it says this, I know it's not a real score. Credit Karma is a real score. It's just not the score we're gonna use. But people not getting pre-qualified because they had their credit pulled, that's exactly what lenders or other
Bad lenders, not you guys.
Yeah,
Not you guys. Bad lenders.
So they use it as a scare tactic, but it's not, like Mike said, it's just a minimal hit. It's a short period of time. If someone's got good credit, there is a window. It's somewhere between 2 weeks and 30 days that you can pull it, the same type of credit score. It's not going to count as an extra inquiry. The problem is not everybody's pulling the same type of, there's even lenders who might, they'll pull a soft pull or they'll pull a different type of score to start out, and then they'll go to a tri-merge. And so what I've said for years is the whole credit reporting industry is as screwed up as a soup sandwich. And so, if they're tight, they want to be careful. They want to, if they know they've got a 623 score, well, let your lender know you've pulled it, when you've pulled it. It's a gamble you've got to take, but we have to pull it. We have to know what the credit is, and we can't transfer credit reporting fees if we don't know what they pulled. So.
Carrie,
I'll
yes.
just add one thing. So if your client is not ready to have their credit pulled, they're not ready to buy a house. They're asking us for several $100,000 and they don't want us to see their credit. I like to explain it to them this way. I say, okay, if something's wrong with your car and you take it to the mechanic shop, do you tell them they can't open the hood? No, you don't. I have to see what's in there. If
You
you're
gotta
not
see
ready,
what's under the hood. I gotcha. Okay.
Exactly. I get it because that credit report doesn't just tell me your score. There's so many other things inside a credit report that we look at that you don't need to know, but that affect your mortgage and affect your ability to qualify. So if you're not ready to have your credit pulled, and then you have these people who would say, I don't want my credit pulled because I don't want my score to be hurt. Well, it's the same thing as the value in your house. The value in your house matters 0 until you go to borrow against it or sell it, right? Otherwise, it's just a place to live. Same thing with your credit score. Who cares if you have an 800 credit score that's sitting behind the door? Your 800 credit score only matters when you're going to go get credit. So we have to look at it. And it doesn't hurt your score. The first time your score is pulled, we're gonna get your score. It's the subsequent times. What really hurts your score is if you're applying for multiple different types of credit simultaneously. You're trying to get a car, a credit card, and a house. Your score is gonna get tanked. But
So
if
it
you're
sounds
just
like
getting a mortgage.
Yeah. So it sounds like it's kind of like dating. You really gotta look behind the profile. You gotta see what's behind there. I get you. Okay.
If people don't have great credit too, the earlier we pull it, the more time we have to help them get where they
That's
need to
a
be.
fabulous
So
point.
I would say, we try to be, lenders try to be the can-do people. Like, okay, I want to buy $1 million house. I make 50 grand a year. Well, you can't do that, but here's what you can do. And so if they're not willing to get their credit pulled, they're either ignorant, which is our job, all of us collectively, lenders, realtors, whoever, to educate them on the credit process, or they're hiding something. And if that's the case, realtors, lenders, we want to get away from them. So
Run.
most of the time it's just education, and the sooner we know the issues, the easier it is to, even if they could qualify right now, if we know earlier, we might be able to improve the credit score to get them better rate, better pricing, those kind of things. So.
And the credit bureaus are, Congress is trying to pass a law. When we pull the mortgage pool, all the credit bureaus selling their information to all these lenders, and they're gonna get bombarded with the phone calls. And I hope they pass the law because it's just.
And those are bottom feeders and
They're
lenders you don't
bottom
wanna work
feeders.
with.
I tell them, hey, people buy your information online and trying to telemarket you, just hang up, you know, always educate your client. You're gonna get a bunch of calls, don't answer them, just hang up.
There's a lot of refinance lenders who
Yeah.
are barely hanging on. You think how tight this market is, and so I will tell you too, it's even worse if it's a VA borrower. So if you're dealing with a veteran and they're working on a VA loan, there's different tricks we try to do. You know, we take out phone numbers and credit score, or email addresses, all these different things. It doesn't work because it's not the lender selling it; it's the repositories. But with VA loans in particular, I just had a veteran who was just looking for a small refinance to an addition, hold his credit. He has received in 2 weeks no less than 300 phone calls.
Wow.
And it's bad for everybody. It's really bad for VA because the streamline, the IRRRLs are so easy to do. There's all kinds of companies just buying those leads by the thousands, and so
I never thought about that aspect of it. Okay.
Oh, and they lie. Now there is a
They
way-
lie? What? What? People lie in real estate? No.
There is a way that you can prevent those, what they're called is trigger leads. So, you trigger the credit report and then all these people who purchase that information get that information. But there's a way to prevent yourself from being on that trigger lead list, but it takes about 30 days for that to come to fruition. You can officially opt out through the credit bureaus from that process. So you have to, as the consumer, you have to contact all three of the credit bureaus and opt out of that so that you
Yeah,
don't get
and that's
that.
fun.
Good luck with that.
Yeah, I was gonna say,
So
that's
it's a
fun.
great education
Yeah.
process though, as a realtor, a lot of times you guys are dealing with people on the front end before we do, and you can educate them and let them know, hey, when you get a mortgage, this is likely to happen,
Mhm.
don't listen to them.
Actually,
Yes.
it's not that hard. I recently did it for myself. You can do it online.
Mm-hmm.
You can go to each of the credit bureaus and they have links where you can just do it online.
I'd like to know what they said about you. All right, guys. So, I know lots of times when you are helping your buyers buy a house, you're on the other side. One of the things that comes up with getting a loan are closing costs. Now, again, depending on the market, we have seen, closing costs being like totally waived. Sometimes they come into play. But your closing costs, what you're asking the seller to pay, really does play a part in your negotiating the deal, okay? Because when you're looking out for the buyer, you're trying to get them the best. When you're looking out for the seller, you're trying to make sure that they get the most money out of it. So, Mike, how much can buyers really expect to get in closing costs?
0 today.
Okay, in a good market.
In the buyer's market, the Fannie and Freddie conventional loans will allow 3% up to 10%. If you put more 10% to 25%, that'll go up to 6%. If you put more than 25% down, it goes to 7%.
Oh, so wait a minute. So it depends on what type loan you're getting
Yeah, and
how much you're putting down.
and government loans, FHA and USDA allow 6%, and then
Oh,
and then VA, they say 4%. They really don't have that limit. They get pretty much you can get around that because you can get seller to pay for a lot of stuff.
so like when I was an agent 15 years ago, when I was 20, I mean it was just kind of like the standard. Like I just always asked for 3%. But so they can actually get more than 3%?
Yeah, well, they can get more. Depends on down payment on the conventional loan. But here's the thing: on a smaller loans like $200,000 or $300,000 house, you're gonna need more than these days with the points and stuff. Because the way the market is set up, most loans are you're not gonna get no point loans on some of the loans with the lower credit scores and things like that. So on a $200,000 loan or $250,000 loan, you're gonna be looking at 4% closing cost total.
Okay.
So, but if seller's not gonna pay, but Virginia Housing also has programs, if you got a 680 credit score, you can roll in 1.5% of points into the loan or closing costs. So
Oh.
that's a good, that's a good product to have.
Okay,
SBA
that's
will
pretty
allow some extra too if it appraises, but, the big thing right now, we've been encouraging people, we are seeing a lot of concessions these days because sellers are getting nervous, market's tight, there's a lot of pent up demand, buyers are waiting for rates to drop. If people are gonna buy a house, they should be buying today. Now, we've been saying that since last fall, because what's gonna happen when these rates drop, it'll be like 2021 all over again. There's gonna be 15 buyers for every listing, and if demand outpaces supply, guess who holds the cards? The seller. And so, right now, people can get closing costs on not every property, but we're seeing more and more of it. Sellers know that in many cases, like Mike said, sometimes they just know there's a lot of loans where there is no 0-point options because the liquidity is not in the market right now, the bond market. Well, if a seller's not willing to pay some points in some cases, they're not gonna sell the house. So today you can get that. 6 months from now, the recession, I think we're already in it. It's about to be called here pretty soon. 100% of the time rates drop in a recession. Mortgage always leads, or housing, both the selling side and the lending side leads going into a recession, it leads coming out. So when these rates drop, housing will do well. There is no bubble right now. So it's really more of a question on the negotiating side, which you guys deal with. How much can
Yes.
they get? Because the programs,
Right.
you get up to 9% depending on the program, but you can get them today. You won't be able to get them when the rates get back down, 4.5%, 5%.
That's why I put this question on there. It was a leading question because your closing costs are part of your negotiation. Okay.
So you just
Okay.
heard two different answers, right? You heard, yes, you get closing costs, no, you don't. The real answer is 42%. 42% nationally of all closings are receiving some form of closing cost assistance.
Well, and that's
So they're
nationally.
both
So
correct.
yes.
So-
yes.
So it's all depends upon the house,
Yeah.
right? Some houses are hot listings, it's going to go over asking and inspection to void only, and you better pay your own closing costs. And other homes, it just depends. And you as agents have a better idea of the feel for that market. You have the ability to look at the MLS and see what the statistics are for that little micro market, that little neighborhood.
Yes,
or
and
what
that's
have
where
you.
the location really does pinpoint, how much of the closing costs that
Well,
someone may or may not
if
be
you're
able to
looking
pay.
at a 90-day listing house, you're gonna get closing costs. Those are houses not in good shape, that's why, or whatever. If it's a nice house, you don't get multiple offers. I've not seen it all day long.
Higher dollar loans homes are sitting there right now, so we'll have to give some things away.
Okay, I like it. All right, so Carrie, I hear people coming in and they're like, I don't have any money. I need 100% financing. So who actually qualifies for 100% financing loans?
So that depends. Veterans, obviously, they qualify for 100% if they have served the requisite term that they need to serve. And we as lenders can check their certificate of eligibility online very easily. Most of the time the veteran knows. Sometimes they think they're eligible when they're not. It gets a little wonky when they're National Guard because there's more paperwork required and a certain number of retirement funds and all this, that, and the other that you don't really need to worry about. The main thing is that if they say they qualify VA, verify that with your lender before you just take them out shopping when they don't have any money.
You guys don't do that, right? You would never take a client out that hasn't been pre-approved, right? Okay, just checking.
So a veteran can make however much money they want to make and still get 100% financing. There's several other 100% financing programs out there that have income limits, which means you can't make too much money. The income limits are pretty high when it comes to Stafford, Spotsylvania, Fredericksburg. But once you get into Orange, or you get into Louisa, or you get into Caroline, or even King George, those limits change. So you need to be very careful with your lender. And also, different programs calculate that income level differently. So USDA calculates the income limit very differently than, say, BHDA, a conventional would. So talk to your lender about what the best program is. There's multiple options. You'll hear 100% FHA. There's different ways to structure that. You'll hear about this FHLB grant where you can get up to $15,000. That's a pipe dream because everybody's standing in line and the money runs away really quickly. So your borrower is, your buyer is counting on those funds. It may or may not happen. You should have a plan B in place.
Well, and some of those too are very location specific, like if they're just trying to grow a certain area. So yes, some of those things may be available, but it's if you're moving out to Bumpus or something like that. Maybe not Bumpus, downtown Portsmouth or something. Yeah.
There's certain areas that are considered areas of economic opportunity. For example, North Stafford. So there's different areas on the Fannie and Freddie maps that the limits can change and they're more generous depending upon the loan program. That's if you have, a conventional type of program. So the bottom line is talk to your lender. Certain lenders also have their own in-house programs, but they do have their own 100% financing program that's completely different from any traditional program that Scott or Mike or I would provide to you.
Okay. You guys have anything else to add to it?
USDA, you don't have to be a first-time home buyer. You can own another house and sell it and buy another house and get a USDA loan. It's not 100% financing. You can get another, 100% financing with the USDA. Also, the first-time home buyer is if you own a primary residence. If your client has 2 investment properties but he's been renting for 3 years, he's a first-time home buyer. Because
Okay.
you have to have 3 years in primary residence. So if you got 2 houses, it's like a client who lived in Texas and rented out and then just been traveling because of work, and he owns 2 houses, they're both rentals, and he's been renting for 3 years and want to buy a house. He's a first-time home buyer. You can get 100% financing on that.
But you cannot get a USDA loan if you own another house.
Yeah, USDA, you cannot own another house as long as you sell it and buy it. But, grant programs, you'll get that. For senior housing, you can get 100% financing. And right now, USDA has the cheapest PMI rate. FHA just lowered their PMI, which is good. FHA's cost 3 times more PMI monthly.
And what is PMI?
It's called Private Mortgage Insurance Thing.
Yes. You guys, you're hearing a lot of acronyms today. So again, if there's something that you hear that you want to know more about, please make sure that you talk to one of them. We'll have some time for questions. But I mean, in the lending world, acronyms are used all the time, and they know what they're talking about.
They use it too.
Yeah. Well,
So PMI, MIP, UFMIP, all of it is the same thing. And the way I explain it to my clients, I like to put it in layman's terms. Look, it's insurance that goes into a bucket of money to pay banks back when people default on their mortgages. It's the money that you pay for the benefit of getting this loan.
It's like FHA is not a lender. There are government housing insurance division. They insure their loan. That's why they collect all that money. So if they default. So FHA, is an insurance agency for the government. That's all it is. Just like any other MI companies, conventionals, they go through normal private MI companies. But government loan, same thing with USDA. They guarantee the loan. They don't service. They just guarantee that they'll pay or they'll pay you the money back. That's why they charge 1% upfront, PMI, and then monthly is the insurance plan against default for the investors are protected.
Yes, and that's a whole nother topic.
That's a whole other topic.
Whole other topic, talking about who actually is backing your money,
Yep.
and and how many loans are bundled together, and okay, we're gonna have to do
And
another
all
panel.
that
I can see
matters
this right now.
zero to you. Matters zero to you as an agent.
So what percentage of those could fail and it really wouldn't affect affect USDA?
What do you mean?
You know, like you said, they pay a certain percentage basically if people default. Well, if that number is it 5%, is it 15%, to where it becomes,
Well,
it's not
it's,
an issue.
you know, that depends on the region too, you know, but round here, not too much default ratio, not too much, because a lot of times people get those loans, and then when they get some equity, like somebody bought in 2019, right? 2020, and then now they got 20% equity, so they would refinance the conventional loan, with that equity, and then you think they'll default on that with the 40% equity? No, they'll sell it before they default and take the money and run.
The agencies are reevaluating that number all the time. It's
Yeah.
basically an annual actuarial exercise, just like an insurance company would do. So, you hear HUD right now, FHA is on the verge of bankruptcy. They've been collecting fees forever. But so the answer to that question today would be different 6 months from now. So varies.
All right, I'm gonna jump down a little bit, because I think question number 6 might take a little bit more time. So, what does a rate lock mean, Scott?
I chuckle because what we hear all the time, okay, I want to lock my interest rate. Okay, we can lock it. And then the next question, what do you think they're going to ask? What happens if rates drop? Well, the idea of a lock is that it is locked, it is fixed in place. So what the consumer gets for a rate lock is insurance. It's protection against the fluctuations of the market. Whether it's a short-term lock, an extended lock, it's insurance. There's a cost for that based on the timeline. So generally, if it's 60 days or less, there's no out-of-pocket cost to them. But if you've got a client who signs a 30-day contract and another client who signed a 60-day contract, does the exact same program, same credit scores, all that, the one with the 60-day lock is probably going to pay a little more or have a slightly higher rate. So the client gets insurance. The investors just basically are hedging that. And so, just like an airline would hedge with oil, the more they know in advance what they've got, the easier it is to balance their books and that kind of thing. So, we're a direct servicer, as mentioned. So, as soon as we put a rate lock in, we also buy a hedge, which is so we can offer this insurance. We're covering ourselves, because if we just said, okay, we'll lock your rate and then we'll gamble on what the market does. Well, if rates go up 0.5% in that 30 to 60 days, then we're losing money. Well, most businesses aren't in business of losing money. So basically, insurance and a hedge. So the idea I've said for years, my view of insurance, I've said to insurance agents, some of you may have been or are, all insurance is a ripoff until you need it. The whole idea of insurance is you're paying for protection against the what if. If you've never had a car accident in 30 years, you wasted a lot of money. Think of the vehicles you could be driving if you didn't waste the money on insurance.
Oh, yeah.
But why do you have insurance? Because, maybe you will look at your phone while you're driving down 95.
No.
Somebody will do
Agents
that.
don't do that. No.
So a rate lock basically is that we're fixing it here and we're going to put the hedge out there to protect you.
Now, when you say hedge, you're talking about putting bushes around the house?
Yes.
Okay, all right.
So somebody somewhere is putting a literal hedge. So like buying puts and calls, people in the stock market, they might buy stocks and then they'll buy some puts or some calls to protect against major moves in the market. So basically that's what's going on out there. And, if we lock a rate in here, we put the hedge in here, let's say the market improves, well, okay, the money's gone for the hedge, but we recovered. If the market gets worse, then the hedge will improve and it'll cover the offset for the loss. So basically the hedge is us buying the insurance that we can offer you to protect you against, or your client against, the fluctuations of the market. Is it a good idea or a bad idea? Well, you won't know until you close, because what I tell people every time we lock, I say, because they always, they want to float. You can get floating rates. So, people say, well, what if rates drop? They want to be able to go lower with the market. They just don't want the risk on the upside. Well, that's still a type of insurance and you pay for it. So if a lender's offering you the ability to float down, they're charging you more for that insurance because there's more risk on their part. So floating rates aren't always a good thing. But what I always tell people, because they wrestle with it, I explain the markets. I never tell them when to lock or when not to, but I educate them. I follow the markets closely. I always tell them, here's the deal. Murphy's Law is true. If you lock today, rates will go down tomorrow, and if you don't, they'll go up. And, but you really need a crystal ball to know whether it's a good decision. None of us have that, so.
We've got some down in our office. No, just kidding.
So it's like buying stocks. I always tell you, you're not going to buy it bottom and sell at the top. You're trying to turn a profit, and so that's what you're gauging the market with that rate lock, and so.
So that was actually one of my next questions on here. You heard him talk about rate lock, and then so what does it mean to float, Carrie?
Float just means you didn't lock it yet. It means your rate's not set. You don't know what your monthly payment is going to be on your house because you don't know what's going to happen tomorrow. You don't know what country's going to decide to bomb another country. You don't know what bank is going to fail next. You don't know what's going to happen. Even the experts who are paid a lot of money to know have been wrong this whole past year. You've heard Michael say rates are going to drop, a recession's coming. Numbers don't lie. I say there's lies, there's damn lies, and there's statistics because you can manipulate numbers. And what we have seen is a lot of number manipulation. So you have two major mortgage rate gurus out there. There's Barry Habib and another guy that I forget his name because I don't pay attention to either one of them. The reason I don't pay attention to either one of them is they have been wrong. One of them said we would be at 5.5 in December of 2022. The other one said we would be at 4.5 by December of 2022. We weren't at either, and we're not going to be because we're in a post-COVID world. All of the prior statistical data that they're basing their analyses off of, yes, it sounds good and it sounds correct, and it would be correct if we were in a normal world. We're not in a normal
This is
world.
not normal? What?
We don't know what this new world of AI and all of these different changes that are going on, this post-COVID, what's happening. So theoretically, yes, we should be in a recession. Will this administration say that we're in a recession? Maybe, maybe not. I personally believe that inflation is worse than what they're saying because I go to the grocery store on a regular basis. I personally believe that we're in a recession because I see what's going on. But the numbers that are being put out don't necessarily reflect that. There's one thing that you can count on, and that is that your borrower can either afford the house or not afford the house based on today's rate. If we knew what was going to happen in the future, we wouldn't need to work. Right?
I want that one.
I don't work.
That's why
Got a
hired.
crystal
That's why-
ball.
That's why you hired me. Yeah.
So
Tell me.
there's a lot of analysis. You could really get into the weeds and get really deep into what affects this and that, and it would all be correct. But how does that apply to you? It doesn't. What matters to you today is can your buyer afford that house? That's all that matters to you today.
Mike, you got anything to add for rate lock or rate float?
Well, if you got a client, I always tell them this, if you got a client closing in less than 20 days, you lock. I mean, you can't take the risk of floating. I tell them, difference between interest rate on 1/8 going up and down is $25 different payment difference. You want to take a chance on $25 difference? They were like, no, go and lock it. Now, if you got somebody closing in 45 days, and I see CPI and all these reports coming out, and I'm thinking maybe you should, this is going to be your call. But I think market's going to improve based on these reports that's coming in, but it's going to be your call. Okay, like yesterday, CPI number was going to be great. Everybody was like, yeah, rate's going to get better yesterday. But it didn't because used car price went up and the cost of living still went up too. So that offset it and rate got worse. So it's gamble. So if client doesn't want to gamble, you just lock it. And you can float down when the rates get better. You can always negotiate with the lender. So,
Negotiate with the.
That's
Negotiate
not
with them.
for-
then.
That's not for publication.
It does. You guys got the same thing, right? Float downs. Everyone's got float downs.
Well, the float down and renegotiation.
Uh-oh,
are two different
uh-oh.
things. You know, yeah, renegotiation. I mean, everything's negotiable
Yeah.
in this world. So, but typically, the takeaway from that is it's not that commonplace. It's not like, hey, rates dropped 40%. I'm going to go get my rate drop. That hedge is out there. That somebody has spent money. So if you lock, say you got a client, you got a 60-day contract, seller's got to do some things, or they're moving out of state, whatever. 60 days, we do a 60-day lock. Lock can happen in 60 days, right? Lock can happen in 48 hours. So let's say rates drop 1%. Well, then the buyer has some negotiating power with the lender, because it's like, okay, fine, if you're not willing to lower my rate, I'll just pull the lock and go somewhere else. So, but renegotiations aren't that common. Float downs are a different thing. That is where the rate lock is, you're basically locking in a ceiling. So it can't go higher, but they can go lower. Usually, most programs, depending on the lender, will offer one-time float down within X number of days of closing, and the rate's got to drop a certain percent. But there is a lock, it's just not a complete rate lock. It's a ceiling, and then you're paying more for that. So you would only want to do a float down if you thought there was a high likelihood of rates dropping in that time frame. It's more common with extended rate locks. So we do a lot of new construction. You lock in for 10 months, a whole lot can happen in 10 months. So
Yeah.
float down might make more sense there, but generally not with 30 to 60
When I think
days.
float down, I'm thinking we're going down to the river. We're
Lazy.
Yes, we're getting in tubes and we're floating down. So,
Well, I used to work for a lender, for instance. We offered to float down on all of our locks. So it sounded great. People liked it. The reality was every rate was a little bit higher because the hedge cost more than the insurance. So, you know, it's all relative. You know, people get too hung up on interest rate, but not that it's not important, but it's not the only thing they should consider. But yeah, everything, you know, it sounds good. Oh, I can float my rate down. Well, yeah, but if they don't go down, you pay more for the life alone for that rate than you could have if you just locked it. So.
all right. So Mike, I know that you had a class on this, marry the house, date the rate, and you explained a lot in detail. So like when people hear like, oh, you know, the Fed is increasing the rates, that doesn't necessarily mean that mortgage rates are going to go up. So what factors really affect mortgage rates?
Well, you know, like today, you know, the Fed said that they're gonna skip raising interest rate. You know, when Fed raises the rate, that's the money that banks borrow from Fed. So, so they borrow money from Fed, and it's usually for the credit cards and car loans and that kind of stuff. You know, the banks borrow money, lend it to them. You know, like they borrow at 4% interest rate and charge you guys 39% on credit card, which is great.
Yes.
Which is best thing ever happened. You know, it's just great. People make money on left and right. So, but it does affect when inflation is involved. You know, Fed's raising the rate so people stop spending money, which hasn't happened because people still spending money. I mean, you go to Wegmans and the people buy milk for $2 more than Food Lion. They don't care. I mean, you look at it's just it's lifestyle. But when Fed raises the rate, it does affect mortgage because the raising the interest rate doesn't really matter. But when the Fed chairman talks at 2:30 and there's a Q&A with all these reporters from Wall Street Journal, Post, CNN, MSNBC, Fox, all them grill this guy. And if they don't like one thing that he says, people, my life's so exciting. I watch these, right? You watch the Fed man, I have the chart, bond market on the one side. Whenever he says something stupid, it's like this.
Yeah, he has his door closed at 2:30. Do not disturb because he's watching this. Yes.
But anyways, it's what he says about the state of economy and inflation and recession. Bond market doesn't like mortgage-backed security bond does not like inflation. So they love recession, but not inflation. So it depends on what he says. So, but you know, when Fed raises rates, that's not mortgage rates that they're raising. It does have effect in different ways. So,
You guys have anything you wanna add to it?
Yeah, the way I explain to people is it's Wall Street that drives mortgage rates. So
Okay.
it's stocks and bonds. Mortgage-backed securities are just type bond. That's what Fannie and Freddie do. They buy these mortgages, pool them together into these collateralized securities, and then it makes them liquid. If there was no that's what we call the secondary market. So you know, you make a payment to Union of Mortgage, we're just collecting money on behalf of Fannie or on behalf of Freddie because we've sold that to them. But if there was no secondary market, you could only borrow what you could get from your local bank. Banks typically, you know, I worked at a bank for years. The banks make money by spread, how much they pay to get the money, and how much they can lend it out for. You know, credit card is a great example. So, you know, banks typically like short-term notes that when they keep them on their books. The secondary market makes mortgages liquid, and so we can offer 30-year fixed rates because if 1 out of 1,000 goes bad, that's not so bad. If a bank loses one loan, they might be losing hundreds of thousands. So banks typically, they like ARMs, shorter term notes, because what they pay for funds goes up.
Arms?
Adjustable rate mortgages, so. But, so ultimately, general rule of thumb, money's either coming out of stocks and into bonds or out of bonds and into stocks. There are some ebbs and flows where they're going the same direction. That's why it's often, like Mike said, it's more important what the Fed says than what they do. They can raise rates, the Fed funds rate, sometimes mortgage rates will drop, sometimes they'll go up, depends on why they're doing it, when they're doing it, how it affects the economy. Right now, inflation is so hot, you know, a bond, you get a fixed rate of return. So if you buy a, you know, 10-year bond at 5% interest for 10 years, you're gonna get 5%. Well, if inflation is at 10%, the return on that goes down. And so ultimately, that's more than all of us need to know, even as lenders. Wall Street's driving that. The market will dictate where the prices are going, what the investors are willing to pay for bonds. That's why you've heard me say a couple times the lack of liquidity. Right now, the bond investment isn't there because of a lot of factors. Normally, there's about a 2% spread between the 10-year yield, 10-year treasury, and a 30-year mortgage-backed security. And if I would encourage all of you to keep an eye on the 10-year yield, you'll have a general idea of what the trajectory of mortgage rates is. Right now, that gap is closer to 3% because of what's going on here. Once the liquidity starts to come back in, that's why we're confident rates are going to drop, because the mechanism behind here, they're just waiting for the Fed to get out of the news. Once the Fed, they don't even have to lower rates right now. The Fed would just shut up and say, we're done. You'd see the liquidity come back in the bond market, you'd see rates drop. Just the spread normalizing would drop rates 1%, 1.5% right there. Forget new money coming in. So Wall Street ultimately is driving the rates. It's not lenders just sitting there, what can we charge today? We make the same money on an 8% rate as we do a 6% rate if it's the same program. So.
Well, y'all are really using some big words today. I don't know about you guys, but I've heard some really big words today. So let me get to the next question here real quick. Carrie, how does an appraisal affect the loan process?
So the appraisal affects, it may or may not affect the loan process depending upon your buyer, the loan program, and the down payment. One huge thing that most real estate agents do not know, which is really important in this area, is USDA, if it appraises over the purchase price, you can roll some closing costs in up to the appraised value. So on every loan program other than USDA, we look at the loan to value. So this is another technical term. Loan to value is how much you're borrowing versus how much the house is worth. So if you have a $500,000 house and you're borrowing $500,000, you have 100% loan to value. If you have a $500,000 house and you're borrowing $400,000, you have an 80% loan to value.
That's why you're that
Okay.
math nerd. You just did all that in your head, didn't you?
Well, that's a pretty simple example, okay? Now, if you can multiply by 2, you can do the math. So an appraisal affects things because because what it does is it affects the loan to value. How that loan to value affects your loan program depends upon what loan program, what your down payment is, and that type of thing. So for example, if you have someone putting 40% down, it doesn't matter if the appraisal comes in low, you don't need an appraisal gap. We restructure our loan so that it's 20, 25%, 30, whatever, doesn't matter, the loan still works. So it really just depends upon the loan program, the down payment, as to how that affects things. Now, if the appraisal comes in low, it's your job as an agent to renegotiate, because that appraiser's job, he has one job, and that is to determine the market value of the property. That's it. And whatever that appraiser decides is the market value, we can pick apart an appraisal and decide, okay, that's not good, and a good lender will maybe order another one through someone else if it's that terrible, or renegotiate the value. But more often than not, most of the appraisers around here are pretty good and are spot on. So the appraisal affects your ability to negotiate. You know, you need to negotiate the right terms. If you're doing an appraisal gap where they're paying a certain amount over. The other thing I wanted to mention is VA loans. Please don't be afraid of those. Those are the only loan that you as an agent have the ability to influence the appraiser, and the appraiser wants that influence. So if the appraisal is going to come in low, they're required by law to notify us, the lender, and we in turn notify you and the listing agent, and you have the ability to provide us with 3 and only 3 comps to help support the value. So you better provide 3 good comps. Don't give me a rambler when mine is a split foyer, okay? Give me 3 good comps to help dispute that. And some VA appraisers are just lazy and they just want you to provide it.
Again, that's another whole.
Whole
That's
topic,
another
but-
whole panel.
But,
Yes.
but it's great. You do have the ability to influence the appraised value.
Gentlemen, do y'all have anything to add as far as appraisals?
Appraisal is a lending tool, and it's an imperfect tool. It doesn't tell you what a house is worth. All of you, I just came from education committee downstairs, so a good plug for what's the designation for
ABR? No,
the one
which one?
for evaluating properties. If you don't know how to evaluate them, you need to educate yourself on that. An appraisal, a house is worth what somebody's willing to pay for it. So, and it only takes one buyer. An appraisal tells us we're guessing what the next person's willing to pay for it if your borrower doesn't. If they stop, we're gonna take this back, what can we get out of it? So every appraisal is old news because they're looking at past data. There's no, unless it's a townhome community with every home built the same or something like that. So you can downplay the fear of appraisals, because you know what happens. Appraisal comes in low. Why am I paying this for this house? The market's going to determine what you have to pay for that house. Just go back to 2020 and 2021. We're still seeing it today, multiple offers, even with interest rates being there. So the appraisal does not tell the client what the home is worth. It tells us what we can lend them or what type of program we can use for them.
And appraisal, all the loans we run it through Fannie and Freddie, automated underwriting system. And lately, we've been seeing a lot of appraisal waivers. I had a client that was going with 6 different offers. Sale price was $350. They got it for $390, $40,000 over. House was underpriced to you, but they wanted to bid more. So my client says, I wonder if he's going to appraise. I said, well, we got appraisal waiver. We don't even need appraisal. Because Fannie and Freddie, they have all the records and they, see what the values are. It's not accurate, but they say, oh, you don't need appraisal, we'll guarantee this loan.
Oh, really?
That's with the and they're putting 20% down, not 40%.
Appraisals will be gone in the next 3
Yeah.
years, probably.
Really?
So all the we've been getting we had one of those for your client too. So we've seen a lot of appraisal waivers with 20% down, even with 10% or 15% down. We've been seeing, the credit score and stuff has factor and loan to value. The debt to income ratio has value, but and my client says, well, do you think I should get appraisal? I was like, you could. What if it comes in lower? And you get pissed off and go back to sell and they turn around and put it back on the market. They have 6 offers. They probably got backup offers. It's like, you're right, why spend $500? You don't have to. So, use that from your survey or something, you know? You're like, do you want the house? Like, no, I don't want the house. There you go, don't create more headache.
When it comes to those appraisal waivers, is there, a way to determine if a home in certain communities will?
No. It's data that, you know, Fannie and Freddie pulls from their, data. Database.
We could run it and see, before your client puts in an offer, we could run the automated underwriting and see if they qualify. A lot of the appraisal waivers, it's not just the property, it's also what the whole borrower scenario looks like as far as whether or not they get an appraisal waiver. So you could have two borrowers side by side and one will get an appraisal waiver and one will not. If you're not putting at least 20% down, the chances are zero. Also, Fannie and Freddie just instituted a new process where there's a different type of appraisal waiver that is not the same as the old, where they're allowing this different type of valuation to be used. But that valuation is far more detailed and far more invasive than an appraisal.
Well, that's Fannie Mae only. Freddie Mac still has true appraisal waiver. Fannie Mae just came up with this appraisal waiver, but they're gonna make the appraiser go out and pretty much do a drive-by type of thing.
A drive-by. Oh, that's
And
fine.
it costs $275, and I'm like, you know what? That's even stupid. You know, for Fannie Mae's appraisal waiver, I'm not even gonna bother with that. Just order appraisal. Freddie Mac still has true appraisal waiver.
PIWs is the acronym, since you guys like the acronym.
It's nothing with the- stop it.
But the one thing, you guys still need to do your due diligence on the valuations. They're not the be all and end all because they are dependent on the rest of the data. It's not just the house. So there are some occasions where you run a pre-qual, you get a PIW, and then as the client's giving you more information, you know, they don't tell us everything up front. I know you think they do, but you know, on some occasions you can have a situation where you had a PIW and then when you finally get all their documentation and now all of a sudden it's not. And so in that case, you gotta scramble and get appraisal. If it's not valued properly, then you know, you're gonna have to adjust some things or they may not get that house, but it is a good tool.
All right, hold on, just 1 second. If you guys would just permit me to keep you for just a few more minutes, how many of you have been hearing all over the news this acronym LLPA? Anybody been hearing about that? Yes, y'all have been hearing about that. Okay, well, it is buzzworthy. It is trending. What does LLPA mean?
Lola loves pink apple.
What? What?
Lola loves pink apple.
Okay, and besides that, what does it mean?
Actually, it's loan level price adjustment, but I like Lola loves pink apple better, don't you?
Okay, all right. So what? Lola loves pink apples. Okay, that sounds like a great drink.
So loan level price adjustment is something
Loan
that
level.
Fannie and Freddie came up with. Okay, so it's, you know, there's a lot of controversies. I get emails from agents why they criticize, you know, why they attacking the people with good credit and money and all that. You know,
Okay.
the rates are high. You heard about that, right? You know, rates are higher with people with good credit and all that. And then, the lower credit, like 60, 620, you know, their rates are a lot better, you know. But, you know, that's only on conventional loans. It doesn't affect government loans. So if somebody got 660 or 620, there's no way you're going conventional to begin with anyways, you know.
Okay.
So they're charging this extra premium. Fannie and Freddie's charging this extra premium. You know, it's like 1.5 points more than what it's worth. It's basically a prepayment penalty that is built into the rate. When Fannie and Freddie buys these loans, and these people are going to refinance in 12 months, and they're paying the servicers and all this money, they're going to lose money. So why would somebody give you a loan to lose money, right?
Is
So-
anyone here working to lose money? No, we're all here to make money. Okay.
So you know they're putting extra money in there, you know, because you know people are not going to refinance. People are going to refinance. They're going to lose money in 12 to 24 months. That's insurance for them. It's like prepayment penalty built into their loan. Okay, to the price. Now, like last 2 years, you know, these banks and lenders, they got this, loans they're servicing like 2.5% rate, 3% rate, those people will never refinance. So a lot of the lenders and banks sold all, man, the last 2 years, you probably got clients like, God, my mortgage got sold in the last 12 months. Because they're selling those low rates at higher interest premium, higher premium to investors so they can make crap load more money.
So
You know,
other people can make money.
Yeah, so
Okay.
there's a lot of selling in the last 12 months because these lenders are selling and banking this money. So it's all, it's like, people, sell milk for $3, but they pay $2.50. I mean, it's not like money, you can't sell it for $2.50 at cost, and then they turn around, drink a little bit, and return it. Say, hey, it's bad.
They're not new though, so loan
Okay.
level price adjustment's been
It's-
around
yeah.
forever. I mentioned earlier, you got a base rate, and that, if a 30-year fixed rate with Fannie Mae is X, or a price they're given, they're giving us the rates for prices, but if somebody's doing investment property, they're gonna get a price adjustment. If somebody's doing cash out at a higher LTV, they're gonna get a price adjustment. If somebody's got a 620 score versus 720, there's a price adjustment. What's happened the last couple of years and why it's in the news is, well, to some extent, it's government extortion, but you weren't rolling over there. But so Fannie Mae and Freddie Mac are owned by the government now. They always will be because it's basically the golden goose. And so last year, early in the year, they rolled out, they went after loans where clients had to have a little more wherewithal, second homes, investment properties. I don't know if you were in that market or helping clients. I mean, if you were doing a 20% down second home now, the loan level price adjustment is 4 1/8 points on top of what the other base prices were. So basically, Fannie and Freddie are their golden goose because they've been making billions and trillions of dollars since they bought it. What happened this year, what put it in the news, was they wanted to make it more equitable, so they adjusted the adjustments. And so people are going to. So the people with higher credit scores are going to pay a higher premium than they would have for adjustment, and people with lower credit scores are going to have a lower premium. They put the head of FHFA put a explanation about it because obviously nobody wanted to hear why am I being punished for good credit, and basically is going back to Tony's question. The actuarial table said we need this money because Fannie and Freddie have been undercapitalized for years. It's true because they strip mine all the profits, and so that's why they don't have the capital. The government spends it other places. So loan level price adjustments are just that. I don't think that one will stick. There's too much uproar about it, but their comment was if we don't do that, then we're just gonna have to raise prices on everybody again because they've stripped mined all the profits. So that's just, anytime you hear of loan level price adjustment, that's just Fannie and Freddie saying we want more, and Fannie and Freddie are the government now, so it's a tax.
And they used to have they stopped it, thank God, because if your debt to income ratios of 45, there was another adjustment for that. They finally got rid of it in April, March or something. Yeah, which saves people a lot of money because people got now like $1,800 car payment, so their DTI is gonna be high because the car loans are high. Car price went up. Average, I had a VA guy the other day. He's like, I can't afford $2,500 house payment. You got $2,000 car payment. What?
That does go to
Is that
your
what
question.
So just kind of going back to the loan level price adjustments, basically it's just an adjustment for each individual scenario. The price, just like when you buy a car, if you get all of these options, it's gonna cost you all of this. If you have, all that really happened, it's not like these people are being charged money. They don't have to pay the money. They can pay a higher rate, or they can pay the money. It's not a fee per se, it's a price for the rate. And what really happened is the people at the lower tiers that were hit hard got hit a lot less hard. And the people in the upper tiers that got credits now are getting charges. So it's not, and it's really insignificant and it affects you as a realtor this much.
Right, and all of that stuff makes my
Unless
head, all that stuff makes my head spin. So, all right, guys, we need to. Has this not been amazing? Let's give our panelists a round